Hi, everyone, I'm Tony Nash, and this is CA Markets Coffee Break. We're looking at a couple of items this week. All these forecasts that we're looking at are based on our CA Markets forecasts. This is an AI-driven platform. We forecast about 1,800 items fresh every Monday morning based upon the latest market data. We show you our error rates. We show you the next 12 months of outlooks for each of those 1,800 items. Today, we're focusing on the 10-year US Treasury yield and the gold price. So you can try CA Markets for free at completeintel.com/markets. So let's start looking at the 10-year Treasury. Let's first look at the last year. We saw an early spike in early 2024. Yields climbed to about 4.6%. And obviously that was based on inflation expectations. We started to see some good economic data, and yields are rising because of expectations of Fed hawkishness. So we saw a dip in late 2024. Yields went under 3.8% or so. So it was really nice for a few months to have lower yields on the 10-year and on the long bonds. Of course, that came with softer economic data, lower inflation expectations, a little bit of Fed dovishness, cooling, and that sort of thing. Then in December, we started to see tones of Fed hawkishness again. So we started to see a year-end rebound, and that's where we are right now. Yields surged back above 4.8% this week on the 10-year. Why? Well, we had a strong Q4 GDP number. We have some geopolitical tensions and, of course, expectations of hawkishness with the Fed this year. Today, we saw some relief with the CPI data. We saw softening in the 10-year, and that's kind of where we expect things to go. So when we look at our forecast, we do expect yields to be in the 4.4% area for the next couple of months, and we expect those to come off in March. So we expect some relief on those yields in March. The drivers of that, the Fed is expected to hold rates steady, so there will be some predictability for the next couple of months. But we have Scott Bessent coming in to head up the US Treasury. He's going to want lower yields on the long end, so on the 10 and 30-year and other long bonds. So we would expect a moderation in those yields coming at the end of Q1, so in March and into April and so on. So it's going to take some work. It's going to take some real confidence that inflation is moderating, and it's going to take some cooperation with the Fed to get some moderation in those long bonds. So in Q2, we expect continued moderation. We don't have that on this chart, but if you look later in CA Markets, we do expect some continued moderation, although not dramatic spikes down from there. But it's in a decent zone for most people. So if we look at gold, again, let's look at the past year in gold. In 2024, we started around $2,000 an ounce. We saw prices rise to about 2,800 in October. Then they fell to around 2,700 in December. Why did that happen? Well, persistent inflation fears, rise in geopolitical risks. Over the past, say, when there were Middle East flare-ups, we'd see the oil price rise because that's where geopolitical risk hit out for Middle East tensions. But this time it's gold. So when we see geopolitical risks rise, when we see fear of inflation, people hide out in gold. To a lesser extent, crypto, but really gold is where people are hiding out. So at the end of 2024, we saw prices stabilize near all-time highs. And as we go into Q1, the real question is, where will gold go? We've seen a little bit of movement in gold, but we do expect gold to remain elevated, possibly revisiting that $2,800 level by March. Again, this is a monthly average. And then we expect later in the year to see potentially further acceleration in gold price starting in Q3. There are some potential headwinds for that. We've seen an elevated US dollar over the last couple of months. There is not necessarily a negative correlation between the US dollar and gold, but that could be a headwind. We could see some geopolitical risk come off if some of these negotiations in the Middle East really take hold and we see peace in Russia, Ukraine, and other things. That could take some of the geopolitical risk premium off of gold. So really a lot of things to watch in that market. But in general, all things held equal, we do expect gold to continue to rise at least for the next few months. So we do have extended forecasts in CI Markets. And again, you can try it for free. Go to completeintel.com/markets and look forward to seeing you next week on CA Markets Coffee Break.